All right, class, let's get started. When you sell something for a profit here in Canada, how the government taxes you really boils down to one critical question. Was it a capital gain or was it business income? Now, the difference between these two isn't just some academic detail. Getting it wrong can have absolutely massive tax consequences. So in this explainer, we're going to crack the code on this super important distinction.
Just before we dive in, a quick acknowledgement for the preparation of this material.
So here's our game plan for today. We'll kick things off with the core question. Then we'll really unpack this idea of intention. After that, we'll look at the CRA's toolkit, how they figure things out. We'll analyze some fascinating case studies, cover the exceptions to the rule, and finally, wrap it all up with how you can build an airtight case for your tax position. Okay, let's start with a really simple scenario. Imagine you buy an asset. It could be land, stock, even a franchise, and then you sell it for a profit. The million-dollar question is literally, how is that profit taxed? Is it a capital gain where, only a portion of it gets taxed? Or is it business income where every single dollar gets taxed at your highest personal rate? Believe me, the stakes could not be higher. And now for the answer, and I really want you to listen closely here because this is the absolute key to everything we're going to discuss. The tax treatment has almost nothing to do with what you sold. It has everything to do with your intention when you first bought it. This is the central principle the Canada Revenue Agency, or the CRA, uses to decide every single one of these cases. So what do we actually mean by intention in a tax context? Well, it's your primary purpose for getting that property in the first place. Were you buying it to use for the long haul to get some long-term benefit? Or was the plan always just to flip it for a quick profit? That purpose, right at the beginning, is what classifies the property from day one. And this really breaks down the two possible identities for your profit. On one hand, if your goal was what the courts call a scheme of profit-making, then the asset is treated like inventory in a store, and that income is fully taxable. But on the other hand, if your goal was to gain an enduring benefit from using it, then the asset is considered capital property, and you get a much, much better preferential tax rate on the gain. And this is the perfect way to think about it. A delivery truck for a bakery is capital property. It's a tool, right? They're going to use it for years to deliver cakes and generate income. That's an enduring benefit. But that exact same truck is just inventory to a truck dealership. They didn't buy it to use it. They bought it to sell it. It's the same asset, but a totally different intention means a totally different tax treatment. Okay, so if intention is so important, how does the CRA figure out what was going on in your head when you bought something years ago? I mean, they can't read your mind. So instead, they, and the courts, rely on a standard investigator's toolkit. It's basically a set of factors they use to infer what your true original intention really was. The CRA and the courts generally look at 4 key clues. First, the period of ownership. How long did you actually hold it? Was it a week or a decade? Second, the nature of the transaction itself. Third, frequency. Is there a pattern here? Are you constantly buying and selling similar things? And fourth, how does this sale relate to your own business or your area of expertise? Now, I have to be crystal clear on this point. This is not some simple checklist where you pass 3 out of 4 and you're good to go. No single clue decides the case. It is all about the big picture, the combined weight of all the evidence. It's only when an investigator looks at all 4 of these factors together that your true intention starts to become clear. So, we've got the theory and we've got the toolkit. Now let's put on our analyst hats and apply this framework to a couple of more complex, real-world scenarios that the courts have actually had to rule on. This case is absolutely fascinating. A company buys a 40-year national master franchise. Almost immediately, they start selling off provincial sub-franchises. But they hold on to the main master franchise for 7 years, collecting royalty income the whole time before they finally sell it. So what did the court do? They actually split the deal in 2. The profit from selling the sub-franchises, that was business income. They were basically treated like inventory. But the profit from selling the main master franchise itself, that was a capital gain because they proved it was held for 7 years to provide that enduring benefit of royalty income. But what happens if your intention changes over time? Imagine you buy farmland with the genuine intention to farm it. That's a clear capital property. But years later, you decide, you know what, I'm going to develop this into a subdivision. The moment you make that decision, the land's purpose changes. It goes from a capital asset to business inventory, and the profit gets split. All the appreciation and value up to that date is a capital gain, and every dollar of profit made after that date is business income. And this brings us to the number one most important rule in a change of purpose scenario. If you want to lock in your capital gains treatment, you must, and I mean must, get a formal professional appraisal on the exact day your intention changes. That piece of paper is your proof. It establishes the fair market value at that critical moment and cleanly separates your capital gain from your business income. Now, while this whole intention test is the default, you need to know that the Income Tax Act does have specific rules for certain situations that completely override this subjective analysis. These are what we call deeming rules, and in these cases, your intention becomes totally irrelevant. For Canadian securities, so things like stocks and bonds, you have the option to file what's called a T123 election. This is a big deal because it locks in capital gains treatment for all of your future sales, which gives you absolute certainty and helps you avoid fights with the CRA. But, and this is a huge but, the choice is permanent and irreversible. Once you make it, you can never, ever go back. And that brings us to a brand new rule for flipping residential property. As of 2023, the government has drawn a very clear line in the sand with a deeming rule that, once again, completely bypasses that old intention test. If you meet the conditions, the profit is automatically business income. Period. And here is that clear line. If you sell a residential property that you have owned for less than 12 months, the profit is automatically deemed to be business income. End of story. The whole debate about what your intention was, it's over. Now, the law does recognize that, life happens. So there are specific exemptions built in. If the sale is forced by a major life event, like a death in the family, the birth of a child, or a marriage breakdown, this automatic rule doesn't apply. And if you fall under one of those exemptions, you land right back at square one, the original intention test, where you have to prove your case all over again. So, we've covered a lot of ground today, from the fuzzy concept of intention all the way to some very black and white rules. Let's bring it all together and talk about what this really means for you and how you can build an airtight case for any transaction you undertake. So here is your final action plan. If you have a property that changes purpose, your very first step is to get that professional appraisal. If you're dealing with Canadian securities, you need to think strategically about whether or not to file that permanent T123 election. And for any residential property sale, you absolutely have to know the 12-month rule and its exemptions inside and out. And let me leave you with this final critical thought. Document everything. Keep your emails, your business plans, your meeting notes, anything that can prove what you were thinking at the time you bought the asset. Because when it comes to taxes, an intention that you can't prove is just a story. So I'll end with this question for you to really think about. Imagine your transaction is under audit by the CRA right now. Looking at the documents you have on hand, is your intention crystal clear? Because if it's not clear to you, you can bet it won't be clear to them. Thanks for your attention, class.